In today's video, we're going to cover some interesting financial, economic, and investment information for 2025. We're going to address some of the narratives that you've heard about in the news, read about, or whatever online of things like, are we in a bubble? What's going on with tariff policy? Is the stock market overvalued? Well, you know what? It's who knows, not me. However, it is helpful to look at actual data, compare what is reality with the narrative. And I think by going over that information, it makes you better prepared to make good investments, whether you're in retirement or preparing for retirement. Investing is part of the foundation of anybody's investment plan or part of their financial plan for retirement. So that's why I want to go over this information today. So with all that in mind, let's jump right into the facts and get right into this video. Yeah, so it's funny. Most of the videos that I make on my channel are all about kind of comprehensive retirement income plans. But at the core of any good retirement plan, well, not for all people, obviously, because not everybody has, portfolios to invest. But for those who are fortunate enough to have that, investing is a huge core component of a retirement income plan. So today's video, we're going to focus all on that. And it's interesting. Everybody kind of, I'll just say I've noticed that as people get closer to retirement and they have less time to accumulate money and now they have more money accumulated, right? They tend to kind of hone in, their antenna are kind of optimized to listen for kind of market and investment information. And so there's always a big difference I notice between what you hear on podcasts or on, videos or on the news or whatever compared with reality. Even when, there's a very credible person, good experts coming on, everybody is presenting information from a particular lens with a particular bias. And so I think it's one of the roles that I serve as an investment advisor is to step back and try and kind of cut through narratives, kind of cut through political or other biases that exist and just present information best that we can of what's going on. And then my job as a fiduciary is to then take that information and try and help people apply it to their own situation as if I were in your shoes, right? To try and help you, apply it. With all that being said, I do have to say, however, big disclaimer, this is not investment advice. The purpose of today's video is it's all education. And I'm hoping that this maybe better equips you to be better informed and make better decisions, investment decisions for yourself. But, don't take anything away from this video and go, oh, I'm going to go do this thing, invest in this thing. That's not the purpose of today's conversation. So let's just jump right into it. I've got 8 or 9 different little slides that I think are really interesting information. At least I think so. So anyway, let's go ahead and start with one of the interesting things that happened this year. I've got a couple of slides on the whole tariff tantrum that the market went through earlier this year. And so with this slide, what we're looking at here is we're looking at market returns for different investment categories. If you had started at the beginning of the year and what happened if you had sold right at the bottom on April 8th compared to owning it through the end of the year. So different categories here, we have emerging market stocks, developed international stocks, it's like Western Europe and Japan and Canada. And then we've got the US large cap market, that's like the S&P 500. Then the mid and the small cap US markets, that's like companies between, let's call it 10 billion down to $2 billion of market capitalization or of market value. And you can see in blue, that's showing you the returns through the end of the year. So 30%, 27%, 17.5%, and then 7 and 3 and 6% for the year. But you can see at the low point back in April of April 8th, you would have been negative at all the market indices had gone up a little bit, but then boom, they had gone down. And if you had bailed out at that point, you would have had negative market returns across the board for the year. So maybe just a takeaway, the whole kind of idea of this slide is the importance of staying the course. And by the way, as we go through these slides, if you would like a copy of these PDFs that I have, just go ahead and shoot me a message or put a comment and I'll be happy to send you a PDF if you want to have these and take a little closer look. There's more kind of interesting disclaimer information at the bottom. You can see exactly the pieces of data that went into each of these charts. Now, this is interesting. It really pairs with the last chart talking about the tariffs. So usually, it's not always the case, but a lot of times when the market is going down, usually the path that it goes down is pretty symmetrical, or I should say it's the way that it goes when it goes up again, it's pretty symmetrical. So if it goes down fast, what I mean by that is you'd expect it to come up fast. If it goes down slow, you'd expect it to kind of recover slowly. Not always the case, but there's a lot of interesting kind of historical market data that really suggests that that's what's most often been the case. Will it be what happens in the future? Don't know, but historically, that's how the market has behaved. And so to that point, the market dropped pretty severely over the course of just a couple of weeks. And when it recovered quite quickly. And so actually on April 9th, that one day, the S&P 500 went up by about 9.5%. Now, depending on which market you were invested in, et cetera, that that would have been a little bit different with each market. But for the S&P, it was a very dramatic up day, 9.5% in one day. That's huge. And so what this chart is showing us is, what if you had been unlucky enough to just miss out on that one up day of 9.5%, and then you invested for the rest of the year? Where would you be? Well, staying fully invested the entire time, end of the year up about 18.9%, compared with 8.6 by missing just one trading day in the market. So again, what this leads me, kind of the big takeaway again here, is that when the market is going down, it can feel the impulse can be pretty strong to just say, I'm going to get out of the market. I'll sell everything. Let's get out and wait for the dust to settle. That's what you hear people say. But the problem with that strategy is you don't know when the market is going to rebound. You might get lucky, and by getting out, you miss some down days. That's definitely possible. But what's also very likely is that you're going to miss some big up days. And if you do, you can see this is kind of a good illustration of the impact on your long-term return by missing out on just a single day. This year was a very dramatic example, kind of to illustrate this general principle. All right, let's keep going with these slides. Another big story for 2025 has been the price of gold. Gold has just done so well in 2025. And in the next chart, we're going to look at actual performance for gold. Actually, we'll see that a couple other times. But what this chart is actually showing us is historically the under or over performance of gold relative to the US stock market. So in blue, all the parts in blue here, these were years when gold outperformed the US stock market, and by how much. And then in black is when gold underperformed, and by how much it underperformed. So you can see that back to the early 2000s. All right, we're looking at about a 20-year chart here. You can see that gold was really outperforming in the early 2000s. Then starting in 2013, this is about the beginning of my professional career, 2013 here. You can see here, gold has underperformed mostly, a little, reprieve here for gold investors, mostly underperformed. And then the last 3 years, gold has outperformed again. Now, will this continue? I don't know, but it is kind of interesting just to see how gold has been performing historically and more recently. So maybe a takeaway here again for just the general idea of diversification. You don't know when a particular asset category is going to do better or worse. So by mixing up your portfolio and having a little bit of a lot of different stuff, maybe even some precious metals, that can be a way that when something is doing well, you can at least benefit from that, in a smaller portion when it happens. Now, this is really fun, really interesting conversation for me to get into, which is this idea of whether or not we're in a bubble. In the headlines all throughout 2025, most of the investment content that I've seen or heard or whatever, it's usually around two categories. It's about gold, or it's about, are we in another market bubble? And it seems pretty reasonable to be asking that. You have the values of several of the big tech companies, like the ones on the slide, like Google and Nvidia, Microsoft, Apple, at all-time highs in terms of the value of their market cap, the size of the company, how much they're worth. So it seems reasonable to ask those questions. We also have some other similarities to the dot-com bubble. In the dot-com period, you had all of these big tech companies, and they had big promises about the future use case of all this technology, about the internet and about mobile. And you had other similar things like huge investment. They were spending billions and billions of dollars to lay fiber optics throughout the country, to be able to bring high-speed internet to everybody across the country, right? And so those are similar to today. We have, new technologies with AI, making big kind of grandiose promises about the use case, about how much it's going to change our economy and everything and how beneficial it's going to be. You have huge capital expenditure, huge investment in these massive data warehouses to provide the compute and the memory for all this AI, as well as a huge build out for the energy infrastructure to provide the energy supply to power all this stuff. So you can see kind of the historical parallel. So I think it's reasonable for people to be asking, oh no, are we in another tech bubble, right? Well, one way to look at that is to look at how much people pay for a dollar of earnings. So the valuation that is used in the stock market to determine if a company is over or undervalued is using something called the PE ratio, the price to earnings ratio. And so that is saying, what price are you willing to pay for a dollar of earnings? So if that ratio is really, really high, it means you're saying, I'm willing to pay a lot of money for a little bit of earnings. And if the number is low, you're saying, I'm willing to pay not so much for those earnings, right? And so if the PE ratio is really high, you would just kind of generally say that company is very expensive. And if the PE ratio is low, then you would say that company is maybe not as expensive. But it's all relative. Relative to what? Well, for this comparison, we're comparing the PE ratios of big tech companies at the dot-com peak back in March of 2000 with big tech companies, their PE ratios today. And you can see the chart, it's a huge difference. So back in the early 2000s, Cisco and Oracle were trading for 120 to 130 times earnings. Microsoft was trading for 60 times earnings, and Intel was trading for 47 times earnings. Well, we can compare, let's say, Microsoft with Microsoft today. It's trading for, the valuation is less than half of what it was back at that time, meaning what people were willing to pay for a dollar of earnings. If we look at two chip companies, Intel versus NVIDIA, same thing. It's about half of what people were willing to pay for earnings of Intel. It's what they're paying for NVIDIA today. And then these big, data, internet infrastructure companies, 120 and 130 times earnings. They don't even compare it all to like Google or Apple today. So the valuations today of companies are much lower. Now, the value of the companies are a lot higher, but what that means is that value is built much more on earnings of those companies rather than on people just being willing to pay for the earnings. So more on reality, less on optimism, or less on speculation, I should say. Okay, now this is kind of interesting. This is a good kind of segue or a good kind of transition from the last slide. So if we look at the total stock market earnings, equity returns for 2025 and where they came from, it's kind of a similar story. The takeaway from the last slide is that valuations today are built far more on earnings than on hype compared to the dot-com bubble. But for 2025 specifically, looking at the entire stock market or the S&P 500, on average, where did returns come from? So you can see that total return about 18.9% for the year. Of that, about 1.5% came from dividends, 4.32%, that came from multiple expansion. So people being willing to pay more for just the same earnings. But here's the big one, actual earnings going up. Earnings growth of 13.9%. That made up the lion's share of the returns in the stock market this year. And so this is a really positive, and if you want to talk about like a healthy or an unhealthy stock market, if the value of the stock market keeps going up, but the earnings of the company stay the same, you're like, whoa, people are getting crazy. They're just bidding up the price. That's PE multiple expansion. You say, oh, that's kind of scary, right? But when the value of the stock market keeps going up, but the lion's share of that increase is due to the earnings going up, and you're like, okay, well, that makes sense. I mean, if you look at it the other way, you can see kind of why it makes so much sense. What if the earnings of companies just kept going up, but the value of the company stayed the same? You're like, what? That doesn't make any sense. It'd be like buying a rental property and you earned, $20,000 of rental income. Like, okay, well, I'm willing to pay this for that. But what if you had another rental property and it made $40,000 of rental income? You would expect the price of that property to be maybe worth twice as much, right? Because you can get twice the rental income from it. You wouldn't pay the same for it. You're like, oh, it's worth more. I get more rental income. That's what this is saying. It's like, oh, if a company earns more money, probably worth more, right? You would expect the price of that company to go up, the value to increase. And so this is another sign of maybe we're a little less bubblicious, a little less bubbly than maybe what you've heard. Okay, not to beat a dead horse, but what we're doing here is we're looking at the path of the stock market of tech companies in the dot-com bubble compared to today. So we're looking at about a 1.5 year period of time going back to, let's see the date here. We're going back for the black line, we're going back to June of 2024 up to the present. And then for the blue line, we're looking at, looks like it's about, let's see, 98, 99, 2000, 2001. This is a 4-year chart kind of showing us the path. So this is going back to October of 1998 up through October of 2001. You can see the price increase. Not only were prices going up so much faster and higher in the dot-com bubble, but they were going up on a lot less earnings. You compare that to today, you can see kind of the rise in prices. It's like not even close compared to what it was relative to the stock market during the dot-com bubble. So again, I think comparisons between now and then are natural for someone to make, given the similarities that I described earlier. But once you look under the hood, the numbers are just totally different. It's very different now than it was then. Okay, this is a really interesting chart. I don't want to spend too much time on this, but one of the things when people are thinking about investing, like, oh, is the U.S. economy healthy or is it not healthy? And one of the things that people use to measure the strength of the U.S. economy is to measure the gross domestic product, right? What is the value of all the goods and services that happen in the country? And naturally, people try and forecast what they think it's going to be. They gather up all sorts of financial and economic information and they make projections, right? And you have a lot of large financial institutions that do this on a regular basis. And when you take all those projections together of a bunch of the big firms, they call that the consensus view. If you look at the average of what everybody's saying, that's kind of the consensus of what people are saying it's going to be. So what this chart is showing us is what was the actual GDP print relative to the consensus. So all the blue bars, these are quarters when the actual GDP was higher than the consensus, and then by how much. And then the black lines, these are quarters when the actual GDP was lower than the consensus, and then By how much less? So you can see that the reason to kind of make this chart, this is looking at the last 10 years back to the third quarter of 2015 up through the third quarter of 2025, is that the actual GDP this year, much higher than consensus, than what it was forecast, but it's a lot higher. 1.5% higher than the projection. And so the reason why that's kind of a big deal is because if you look at that outperformance of the US economy, even other times when the performance was a lot higher, it was barely, it was not nearly to this magnitude. And so again, I think, the market is kind of a living, breathing thing because it's a real-time sentiment marker of kind of what people think, kind of how optimistic or pessimistic they are about what's going on. And so generally, when you've got all the smartest people supposedly saying that, oh, this is what the GDP is going to be. And it turns out it's significantly higher than that. I think this is just maybe a takeaway I would take from this is that, it's helpful to get good information and listen to experts in different fields, but everybody is subject to bias. Everybody is subject to just, in good faith, just getting something wrong. What this means to me is staying invested even when things seem pessimistic. And then or even if things seem really optimistic, not going all in and being crazy. Don't go and borrow a bunch of money against your house to invest more just because things are optimistic because people get it wrong. So staying diversified, staying balanced, listen to good information, but also, okay, well, maybe that doesn't turn out like people are thinking. So let's stay diversified. Let's stay measured. Okay. All right. This is kind of an interesting thing. I don't know how relevant you'll think this is, but looking at U.S. tariff policy, this chart is going back showing effective tariff rates from today all the way back to 1790. And you can see that the implied tariff rate right here in black, this is, I guess if all of the proposed tariff rates under the current Trump administration go into effect, what that would be, you can see that, well, it's a lot higher compared to, the last 30, 40 years, but relative to U.S. history, it's maybe at the lower end or kind of maybe about average. If you took the highs and the lows, you would see that maybe the average is about 20-ish%. The real outliers, the last basically post-World War II era of globalization, tariff rates have been very low. But for most of our country's history, we've had much more of a protectionist policy, had much higher tariffs. So maybe takeaways from this, trying to make investment decisions off of this, I wouldn't even know where to begin, honestly. But a takeaway that I would have is that when you hear narratives about, oh no, tariffs are going to ruin everything, or on the flip side, oh, tariffs are going to be the best for everything, I would say probably, maybe it's a lot more of a balanced and mixed bag. But one takeaway that I'm trying to get across here is that if tariffs go up, then I don't know if it'll be good or bad for the economy. But what this chart shows me is that our country has functioned well, presumably during many of these eras, during periods of much higher tariff policy. We've had good times and bad times with high tariffs. We've also had good times and bad times with low tariffs, right? So tariffs are a variable, but they're not a monolith. They don't determine everything. So kind of interesting information, right? Did you know that we had tariffs up near over 50% for periods of our nation? I didn't. So anyway, interesting. All right, now for this chart, we got two more charts here. We're going for a sector breakdown of the U.S. stock market. And if you would ask me what sectors did the best, I probably would have told you technology, but turns out, hey, it was actually communication services was the best performing sector of the U.S. economy this year. But from a stock market perspective, technology, probably could have guessed this, that it had done really well. But things like industrials and then utilities and financials up all near the top, and healthcare, all really good double-digit performance. And then at the lower end, energy, discretionary and consumer staples, and then real estate, the lowest performing sector of the U.S. economy. Again, here, the idea of staying the course. All of these diamonds here, these are all showing the intra-year, like during the year, the lowest point that any of those sectors hit. So again, if you would have stayed invested, you made 33% in communication services, but there was a point at which you would have been down by 22%. So again, staying invested, another key takeaway. And then our final slide, if there's an overarching maybe takeaway from the information today, it's the idea of diversification of not knowing what's going to happen at the beginning of the year. So if we look at takeaways looking for the year ahead, the idea of diversification is I think is central. So here we're looking at different investment categories from across the world of investing, and you can see kind of how things have done. And pretty interesting things here. First, namely, gold doing very, very well. Again, last 10 years, not so great. The last 3 years, pretty darn good. And this year, very good, up almost 65% for the year. Now, does it mean that that's going to happen next year? No, it doesn't mean that. Could it happen? It could happen. I don't know if it will. I'm not willing to go all in and bet everything on gold, but I am willing to diversify, because maybe it'll go up. But if it does, or if it doesn't, I don't want to be all in on it, right? And have everything go down. Other big takeaway here, international markets. Another big kind of narrative busting investment result this year. International markets have done very well, up 31%. Kind of interesting. If you invest in a lot of Vanguard index funds, like global index funds, I found that Vanguard products have a higher allocation to international stocks than index funds from other index fund providers. You know, if you've been in Vanguard funds this year, you've probably been very happy with your performance. Commodities this year up 18%. The U.S. stock market 17.4%, and then small and mid-sized U.S. stocks, bonds, inflation-protected treasuries, cash, commercial publicly traded real estate, and then Bitcoin. Here's the other big surprise. Earlier this year, Bitcoin was up quite a lot for the year. This is probably the most volatile thing this year, of watching Bitcoin go up a lot this year and then come down and stay negative for the rest of the year. It was down by more than this early in the year. I think it's actually come up a little bit. But again, big takeaway here is diversification. We're looking at 2026. You don't know what's going to happen. Even with the best information, even with economists and having the consensus view, even knowing whether or not there'd be tariff policy, or even if you knew whether interest rates were going to go up or down, it would be very difficult to make the right and bet 100% on the right investment for the upcoming year. So again, staying diversified, I think, is the best course of action. So hopefully from these charts that we've talked about today, maybe if nothing else, it's been kind of interesting for you. I know for me, it definitely is. This is the type of stuff that I love to dig into. But my hope is that with this information, you're better educated, more well-informed about some of the pitfalls of investing, some of the shortcomings of projections and forecasts, and maybe better informed about some of the principles like diversification and the positive impact that can have for both protecting your retirement portfolio financially and not providing any guarantees, but maybe trying to stack the deck in your favor to have the best possible outcomes. So if you'd like some help building your retirement plan, I'd be happy to sit down with you one-on-one. You can click the link in the description. And if you'd like a copy of these slides, just go ahead and shoot me a message and I'll be happy to send you the PDF. So with all that in mind, it's been fun going over this with you today, and I hope you have a great week, and I'll see you in the next video.